Welcome to Talking Business, a podcast produced in Melbourne, Australia. The podcast is available on the Acast site, my own website, the Apple Podcast Store, or wherever you go to get your podcasts. Or you can get it at the Business Acumen website at www.businessacumen.biz or at Banking Day. For the most exclusive access to leading economists and business leaders from around the world, subscribe to Talking Business from my website, leongettler.com. I am Leon Gettler. My job is to review and monitor the week's news in business, finance and economics. I bring it all to you every week. This is episode number 25 in our series for 2024, and today's date is Friday, July the 19th. First, I'll be talking to Alex Perry, the Managing Director of investment company Sharewise. Alex has a strong history of working in the investment management industry. We'll talk about how geopolitical conflicts in the Ukraine and Gaza are affecting markets, and we'll talk about the market impact of the US presidential election in November. And I'll talk to RMIT economist Sinclair Davidson about whether this downturn is worse than the GFC. But first, let's talk to Alex Perry.
Well, Alex, there's a lot of geopolitical tensions in the world now with Gaza and Ukraine. How's that affecting markets?
Well, I mean, when the Ukraine war happened, or the invasion of Ukraine happened in 2020, I think it was the S&P, or basically the US markets, fell by about 35% in that first month. So it was quite significant. And I think generally when there's a war that happens, you get a contraction of global GDP by at least 1 to 2%, because what happens is people don't have the confidence to keep spending or the confidence to keep trading or investing because they've de-risked, which is only natural. You know, if there's a fire, you get out of the house, or if there's smoke, you get out of the house. And it's basically what we saw during the Ukraine war, which is still going, mind you. But if you have a look now, I guess 4 years afterwards, you know, we're effectively at all-time highs again on the S&P. You know, we're at close to all-time highs again in the Australian markets. So we've had a bit of a bounce. It's people need to park their money somewhere, and people are going to be continually speculating on equities and just basically getting better returns on equities rather than just keeping it in the bank.
So people have acclimatized to the wars, more or less.
Correct.
Right?
Correct. Yeah, it's basically, I think the initial shock of it happening as well. I think the Ukraine invasion was seen geopolitically as more of a risk to global markets than, for example, the Gaza war, because I think there's been a bit of a flock to oil, but we've seen oil sort of like tank a little bit because the Middle East is not playing ball at the moment with regards to barrels. There's no caps. And so we've seen oil rally a little bit again over the weekend, because I think Hamas is potentially going to be not encouraging, but open to a potential ceasefire, which is basically proposed by the United States government.
So again, so everyone will be watching that very closely.
Yeah.
And they'll also be watching what OPEC does.
Correct, which is the majority Middle Eastern countries.
Right, and of course, so you've got Russia as a supplier as well.
Correct.
Right, so it's all interconnected.
Which is an adversary to the West at the moment in the United States. So there are a lot of players, or you could say actors in this whole thing, and there's a lot of vested interests at play as well. So unfortunately it's not always straightforward.
The other big issue is what happens in November with the US election, and how is that going to affect the markets. And I noticed Wall Street was recently speculating about what a Donald Trump victory would do for the bond market, for interest rates, for tariffs, etc. What's your view about that?
I mean, like or hate Trump, he's certainly a polarizing character. And I think Wall Street loves Trump because Trump loves business and Trump loves the stock market. I'm not sure if you remember when Trump was in power, when he was president, and he was putting a lot of pressure on Janet Yellen with regards to the interest rate rises from the Reserve Bank in the United States. So he likes using the stock market as a litmus test of his presidency, right? So, he's pro-business, pro-stock market. I think he's even basically said now that he's, pro-Bitcoin and pro-cryptocurrency. So I think all the Wall Street and certainly traders and stockbrokers, they're very, very bullish for a potential Trump victory, because, less company tax and a rallying market again. a continuation of the rallying market.
But you've got potential with things like tariffs putting pressure on inflation.
Yeah. I mean, I think Trump, or hopefully Trump, has learnt a lot from his last presidency and basically the trade wars. And let's not forget, in fairness to Trump, Biden's continued those tariff wars with China. So Trump put them in, and while the Democrats like to hate everything that Trump did, they've continued a lot of things that Trump had in place, i.e., these tariff wars with China, and there's just continuation there. For example, the blocking of TikTok out of the US market. So all of that stuff's continuing. Those geopolitical tensions with China. So I think Trump might rein that a bit. I think if Trump can get growth by just having better relationships with Russia, better relationships with China, and certainly like North Korea, for example, having a good relationship, a peaceful Middle East, as opposed to not, he will continue to do that, and he'll make sure that occurs.
But the stock market has gone up similarly in the Biden regime as well.
It has. I mean, it is very, very difficult. I think what happened was Biden came in on a recovery of a COVID lockdown, which we've basically had for 2 years. And so everyone went back to work. They've had to get inflation in check. And so their confidence has just increased in the whole global economy. I think when Biden came into power, I think China was still in lockdown, let's not forget. So China basically abandoned their hard lockdown policies because, a lockdown is not going to be good for China nor for any other economy. And so I think Biden's basically got off the back of the reopening of the globe, just a continued growth there.
So he was very fortunate.
Correct.
How would the stock market regard a Biden victory?
Well, I think the great thing, let's not forget, the great thing about politicians is they can paint a very, very, very positive picture. And I think if the market is bullish, the market will, and I think the market is bullish because it basically is going up on bad news. It's going up, off the back of wars or continuing wars. It goes up off the back of inflation that continues to remain, certainly in Australia. But in the United States, inflation looks like it's a bit in check. I think a Biden victory is probably I'm guessing, nobody knows, but I'm guessing it's going to be seen as positive as well. Because what the United States wants and the whole globe wants is a continuation of good times. That is what's got the whole world into this big mess that we're in at the moment, the continuation of good times. We don't want the debt ceiling to be hit in the United States. We don't want there to be a complete reset. We just want a continuation of good times. We just want all-time highs. We want good lives, a continuation of property, continuation of the stock market. So I think what's happened is the society and the whole world just continued growth at all costs.
And everyone is anticipating that inflation will come down eventually.
Well, they're already seeing that in the United States. They're seeing basically unemployment continue to track up a little bit. We're even seeing that in Australia. However, we're in a different state in that our CPI figures, so our inflation index has gone up last month. So there's a potential that we might get an interest rate rise in Australia, or the chance for an interest rate rise in Australia in August has increased, so which is having a negative effect on the markets at the moment. Whereas I think in the United States, they're continuing with their statements of a potential 2 interest rate cuts before end of the calendar year this year.
Well, one of the great things about markets, of course, is that there's always an anticipation that something is going to happen. And so trading is always factoring in something. So they might be in Australia, they might be factoring in, there might be an interest rate rise. What does that mean for us? And so that would continue in the trading here.
Correct. I mean, if there is going to be an interest rate rise in Australia, there's basically monetary policy is just there to control the flow of money, right? So an interest rate rise in its effect, of the reason why they're doing it is to try to constrict more spending. So trying to constrict spending on property, it will constrict absolutely the investment into the stock market, as the AUD will go up if there is an interest rate rise. And it'll certainly hit the back pockets of the consumer in Australia, because I I think the last statistic was about 40% of the population is encumbered with mortgages.
Mm.
And so an interest rate rise would obviously constrict the back pocket there. And I don't think anybody wants the economy to grind to a halt. And that's why the RBA's interest rate policy is very, very important, because it's a balancing act, and you've got to do it slowly. And so, I think it'll just have the effect of constricting everybody's spending. And certainly it's going to have a constricting effect on the stock market as well.
Well, we'll watch that with a great deal of interest, Alex.
Yeah.
Okay. Well, look, it's been great talking to you. Thank you so much for your time.
No problems. Thank you very much.
And now let's talk to RMIT economist Sinclair Davidson.
Well, Sinclair, there's been a lot of speculation that this downturn could be worse than the GFC, with all the insolvencies rising, and you've got inflation, and you've got the RBA. And what's your view about this?
I think it's not going to be as dramatic, perhaps, as the GFC, because if you kind of remember back to the GFC, there were significant events that suddenly occurred that everybody looked at sort of the collapsing of Lehman Brothers and all this sort of stuff and said, oh my goodness, there's a crisis on. What is happening this time is there is a crisis on, but unfortunately, we seem to be slipping into this crisis simply because people aren't paying too much attention. Now, my view is that this is a continuation of the GFC, is that we never really recovered from the GFC. If you think about when COVID hit a few years ago, we were still doing quantitative easing, we were still running massive deficits, we were still running up debt, and everybody was thinking, oh yeah, we've recovered. But in actual fact, our fiscal situation never got back to where it was. And so we were weakened by the GFC. We then had the hammer blow of A, the pandemic, and B, the pandemic response. And so we are now sort of reaping those dual whirlwinds of never having fixed up from the GFC and the fallout from the COVID pandemic and the response to that pandemic.
The response to the pandemic could well have fueled the inflation figures.
Oh, no, absolutely it did. But I think the real effect here is it actually made quantitative easing difficult to continue. So what happened, if you remember back to the pandemic, we had to close down the economy to save health systems and prevent deaths and all this sort of stuff. And that seemed plausible at the time. And then to prevent our societies from collapsing because we were forcing people to not work, we had to pump money into the economy to get people still buying goods and services. So what happened is we had very little production taking place while we actually had more money coming into the system. So that, of course, had an inflationary effect on the economy, which, to be fair to the Reserve Bank, at the end of the pandemic response, there were two things going on. One, there was the inflationary process going on, and two, there were the disrupted supply chains. And both of these things cause increases in prices, but the Reserve Bank only wants to deal with inflation. It doesn't need to deal with disruptions to supply chains. So they were waiting to see whether or not this was a supply chain problem or whether it was an inflation problem. And in retrospect, it was obvious that it was more of an inflation problem than a supply chain problem. But nonetheless, our Reserve Bank was too cautious then and was late coming to the party in raising interest rates. And for different reasons, our Reserve Bank is being too cautious now and also not raising interest rates as quickly as it should have. I really expected at the last meeting they would definitely raise rates. And to be quite honest, they should have raised rates before then. I think it's very likely they will be raising rates at the next meeting because the inflation number is starting to embarrass them. And quite frankly, the credibility of the Reserve Bank is now coming under threat.
The history of rate rises is that there's not just one, but there's two.
Yes, going back in memory, yes, there's normally a smaller one just to see what's going to happen, and then perhaps a bigger one, or sometimes there's a bigger one and then follow up with a smaller one because they don't want to shock the economy too quickly at one time. But I kind of think we're at the point now where the economy does need to have a bit of a shock because inflation, once it sets in, is a very serious long-term problem that you actually want to avoid. So this is much like pulling off a plaster. You can pull off the plaster slowly, or you can pull off the plaster in one big rip. And we all like to pull off the plaster slowly, but in actual fact, pulling it off in one big rip is the way to go. And the plaster analogy works well because, as I've said to you before, this is the economic equivalent of medieval bleeding. We are going to bleed the patient. And the challenge is in bleeding the patient so that they don't die from the bleeding, but nonetheless, they actually recover. And that is the tightrope situation the Reserve Bank has got to walk. And I think right now, now they've been going about this too slowly.
This is very similar to the analogy drawn by the Bank for International Settlements, which last week was warning central banks not to cut interest rates because of fear of inflation. And they were saying, look, it's like giving antibiotics to a sick patient. You just have to do it.
Yes, it is. It is one of these things. And I understand that, we've got a new Reserve Bank governor, and even worse, we've got a Reserve Bank board who don't actually know what their position is going to be. So if you think back to the review the government had about the Reserve Bank, there's going to be two boards. There's going to be an interest rate board, and then there's going to be a governance board. Right now, everybody's on the interest rate board. And I think everybody on the interest rate board wants to stay on the interest rate board. They don't want to be pushed into the governance board. So nobody wants to do anything that's going to upset the government, because they will find themselves on the governance board fairly quick smart. So we've got a Reserve Bank at the moment that's conflicted. But nonetheless, as my very first economics lecturer said to me in the middle of the 1980s when I started doing economics, when you've got economic problems, the solution to those problems are always going to be painful. And I kind of think that perhaps people were misled during the GFC when we were all being told there's no trade-off between health and the economy. Well, there's always a trade-off, because at some point you've always got to pay. And we are now paying the price of the choices we made during COVID in response to the pandemic. This was always going to happen, and it is happening now. And I think we've got to try and endure that pain as quickly as possible, raise interest rates as much as possible to kill off the inflation, and then actually get on with it.
There's several issues here. One is no one foresaw the number of insolvencies, particularly in the construction sector.
My colleagues at RMIT and I wrote a book basically saying you can't shut down the economy and then start it up again without causing dislocation in the economy. So true, we did not put a number on it, but we did actually foresee that there would be economic dislocation coming out of this. I think the challenge is when it comes to construction, we have the most amazing combination of things. We have housing prices which are out of control, and at the same time, we've got the people who supply housing going broke. That's an astonishing problem that we have that is fundamentally caused by inflation, because there were no inflation clauses written into those construction contracts. So the price of construction goods has gone up dramatically as well, but no construction company can honor their contracts without going broke. So that is a problem that's going to work through the system. We will see we have seen a lot of construction companies going broke, and we will see them restore at some point in the future.
The issue with contracts is interesting because, Donald Trump, for all his issues, was the one who showed that contracts can be always rewritten.
I think historically the construction industry have had a fluid approach to contracts and contracting. I think Mr. Trump's quite famous for that. I read his book, his autobiography in the 1980s, where he brags about this. This is how business is done. But I don't think he's alone in that particular situation. What is interesting, what Mr. Trump is doing, he's promising that tips in the United States will be tax-free. And that's going to be very interesting, because if anybody's traveled to the United States, the tipping culture there is completely out of control, where tips have increased from sort of an expectation of 10% to an expectation of 20%. And I imagine if tips do become tax-free, we're going to see lawyers getting paid by tips. I'm going to insist as an academic, all my employment is going to be from tips. So that a funny thing that is up to nowadays.
Now, the other issue too is that you've got with construction, they're saying they can't actually build the 1.2 million homes the government has foreshadowed, and as a result of that, we've got a housing shortage, and as a result of that, we've got higher rents, and that's contributing to inflation, and that's a structural issue.
Yes. Bearing in mind, there's a whole bunch of things going on here. The fact that we've got a housing shortage leading to an increase in housing prices and rental prices and what have you, that is not an inflationary problem, even though it results in house prices and prices going up, generally speaking. And rents are a factor in the CPI calculation. Unfortunately, we have a lot of confusion in our economy where we kind of view that any increase in prices is an inflation problem. That's actually a supply problem. That's a problem whereby we actually have a shortage of things. And when you have a shortage of things, the prices are supposed to grow up so that you will have a demand, that will either stifle off demand or it'll increase supply. But we do have the structural problem, and we've got several structural problems across the economy where we have a combination of regulations and laws and different practices that are all combining together to make it difficult to do things. So there was an article in the Financial Review a few weeks ago about Sam Kennard, the guy who owns all the warehouses. He wants to build a pub on one of his properties. Now, he owns the land already, but because of all sorts of zoning and regulations and all these sorts of requirements, it's taken him 18 months so far just to build a pub on his own property.
Which is interesting, because that's my other theory, is that there's a lot of talk about the lack of productivity in Australia. My view is the lack of productivity doesn't come from workers, it doesn't come from companies, it comes from bureaucracy.
Yes, that is absolutely true. And we see this all over the place, is that bureaucratic controls over the economy have sort of stifled anybody's ability to do anything. So even if you want to build a house now, or even make a modification to your house, you've got to end up going through a 6 to 9 month process where you get planning approvals at great expense. So whenever economists and politicians, well, so certainly when economists start talking about productivity, everybody starts thinking, oh, those economists want to drive down wages. Actually, if we had a more highly productive economy, wages should be rising because we're actually creating more value, doing more stuff. So the challenge that we have right now in Australia is that there are far too many busybodies actually sabotaging our efforts to get things done. And as I've said to you before, the problem is that during COVID, we didn't just stop the economy, we actually destroyed a lot of our wealth. We are not as rich as we used to be. And as a consequence, a lot of our regulations are far bigger in their impact on the economy than they should be, simply because the economy that we designed them for is actually gone. We were actually poorer now. We need to be working harder. We need to be earning more. We need to make sure that we are doing more, and shuffling paper to prevent people from doing stuff is not work.
Well, Sinclair, that's all quite illuminating, and thank you so much for your time.
Thank you very much, Leon. Good to chat again.
So what's happening in the news? Well, as world financial markets reopen after the attempted assassination of Donald Trump, one thing seemed likely. The Trump trade will continue to get even more momentum. The series of wagers based on anticipation that the Republicans' return to the White House would usher in tax cuts, higher tariffs and looser regulations had already been gaining ground since President Joe Biden's poor performance in last month's debate imperiled his re-election campaign. But the trades took deeper hold, with Trump galvanising supporters and drawing sympathy by exhibiting defiant resilience after being shot in the ear on stage at a Pennsylvania rally. There was no commentary about him going off to play golf the next day. Treasuries fell as trading kicked off on Monday, with long-dated bonds underperforming on anticipation for Trump's fiscal and trade policies will fan inflation. The dollar edged higher against most peers. Bitcoin rose above $60,000, while futures on the S&P 500 index for September climbed 0.2%. To be sure, there's still plenty of room for surprises, almost 4 months to go in the US election campaign. The emergence of political violence may deepen concern about instability in the US and push investors into haven assets, potentially overshadowing some of the market positioning that has already taken place in the run-up to the election. Moreover, some investors may want to book early gains or be wary of getting deeper into an already crowded position, while traders generally don't expect Trump's assassination attempt to derail the stock market trajectory in the long run. A pickup in near-term price swings is likely. The market has already been contending with speculation. The valuations have become too stretched given the boom in artificial intelligence stocks and the risks posed by elevated interest rates and political uncertainty. But investors have also been anticipating that bank, healthcare and oil industry stocks will benefit from a Trump victory. The attack will boost volatility, said David Massa, CEO at Roundhill Investments, predicting investors could seek temporary safety in defensive stocks like mega-cap companies, while bond traders have been pricing in at least 2 interest rate reductions in 2024. A major boost in Trump's election odds could push the Federal Reserve towards staying on hold for longer, according to Michael Purvis, CEO and founder of Tellback & Capital Advisors. Trump's stated policies are, at least now, more inflationary than Biden's, he wrote, and we think the Fed will want to accumulate as much dry powder as possible. And Elon Musk has said he plans to commit around US $45 million a month to a new super political action committee backing former President Donald Trump's presidential run. Other backers of the group, called America PAC, include Palantir Technologies, co-founder Joe Lonsdale, the Winklevoss twins, former US ambassador to Canada Kelly Craft and her husband, Joe Craft, who is chief executive of coal producer Alliance Resource Partners. Formed in June, America PAC is focused on registering voters and persuading constituents to vote early and request mail-in ballots in swing states according to one of the people. The coalition assessed that the Democrats have historically had very robust get-out-the-vote campaigns and took note of the amounts of money that the Biden camp has dedicated to so-called on-the-ground efforts in swing states. America PAC will try to counter that. Musk in March tweeted that he didn't intend to donate to either Trump or President Biden's campaign. But the billionaire Tesla CEO has gotten closer to the former president in recent months. On Saturday, Musk formally endorsed Trump for president after a shooter attempted to assassinate the former president in a Pennsylvania rally. "I fully endorse President Trump and hope for his rapid recovery," Musk said on X. In a subsequent post, he said, "Last time America had a candidate this tough was Theodore Roosevelt." Musk and Trump had been talking frequently in recent months and were developing a friendly rapport, and Musk was helping organise a data-driven project to prevent voter fraud that Trump was briefed on. The two men had also discussed a possible advisory role for Musk in a potential second Trump administration, something Musk later denied. And the International Monetary Fund has warned that high inflation is proving more persistent than expected, potentially forcing central banks to keep interest rates higher for even longer than predicted. Despite the better-than-anticipated US inflation figures, the IMF warned on Tuesday that momentum on global disinflation had slowed, largely due to ongoing elevated rates of services inflation. Risks of persistent inflation in the services sector are tied to both wage and price setting, given that labour accounts for a high share of the costs in that sector, the IMF said in its quarterly update of the World Economic Outlook. In Australia, economists say that the June quarter Consumer Price Index on July 31st will be decisive in determining whether the Reserve Bank of Australia will be forced to deliver a 14th interest rate rise at its August 6th board meeting. With underlying inflation running about 4%, markets are pricing in a 16% chance the RBA will raise the cash rate to 4.6% from 4.35% when it next meets. Services inflation was 4.8% in the year to May 31st, well above the RBA's 2 to 3 target, according to figures from the Australian Bureau of Statistics. Rapidly rising rents, airline fares, health costs and insurance premiums were among the major drivers of services inflation in Australia, AMP Deputy Chief Economist Diana Messina said. An increase in the cost of vehicle repairs and haircuts was also keeping services inflation elevated. IMF Chief Economist Pierre-Olivier Gourinchas said further challenges to disinflation in advanced economies could force central banks to keep borrowing costs higher for longer than markets predicted. That would put overall growth at risk, with increased upward pressure on the dollar and harmful spillovers to emerging and developing economies, he said. The IMF revised its near-term forecast for Australian economic growth slightly lower. It expects the local economy to expand by just 1.4% in 2024, down from 1.5% previously, and by 2% next year. And in an unwelcome development for the Australian economy, China's economic growth is expected to decelerate to just 3.3% by 2029, down from a forecast 5% in 2024. Despite the upside risk to the global inflation outlook, inflation is still expected to return to central bank targets by the end of 2025 as unemployment inches higher and energy prices decline. Monetary policy rates of major central banks are still expected to decline in the second half of 2024, with divergence in the pace of normalisation reflecting varied disinflation circumstances, the IMF said. And the federal Labor government has appointed an independent administrator to overhaul the CFMEU and clamp down on criminal elements within its ranks amid growing concern at the damage from gang-related figures at mammoth building projects. The move will impose tight controls on key parts of the union after days of revelations about its ties to organised crime, as employers call for a judicial inquiry into allegations of kickback offers and other deals that have driven up the cost of construction. Prime Minister Anthony Albanese has expressed contempt for John Setka, who has quit as secretary of the Victorian branch of the CFMEU and vowed to take whatever action is appropriate to fix the problems within the union. Senior cabinet ministers have played down the option of deregistering the union because this could repeat the mistakes made with the precursor to the CFMEU, the Builders Labourers Federation, or BLF, after it continued its misconduct despite being deregistered. Significantly, and it's something the Labor government didn't say, was that when the BLF was deregistered, other building unions recruited tens of thousands of BLF members in New South Wales, Victoria and the ACT. In the early 1990s, the building unions formed the new super union, the CFMEU. The move to appoint an outsider to run the union gained momentum on Tuesday after the CFMEU National Secretary, Zach Smith, voiced his support for Setka and argued that action by the National Office would be enough to deal with the problem. The move comes after the federal government said an email about the CFMEU 2 years ago had not gone to the Prime Minister's office. The correspondence was first sent to an inactive email address, the government said. It was then sent to the Contact the PM website and left with the Department of Prime Minister and Cabinet. While the coalition demanded answers about what the government was told in 2022, the government confirmed the Prime Minister's office did not receive the correspondence. A key factor in the federal decision to appoint an outside expert to run the CFMEU is the experience of a union scandal in 2012 when Bill Shorten, as Workplace Relations Minister, named an independent administrator to run the Health Services Union due to fears about the misuse of membership funds by top officials. Ministers believe the decision to appoint an administrator avoids the problem of trying to deregister the union in the same way Prime Minister Bob Hawke moved against the BLF in 1986 due to concerns about corrupt behaviour by its leader Norm Gallagher. The advice to the government is that deregistering the CFMEU would not work because the union could continue to act against employers, negotiate enterprise bargaining agreements and represent workers without cleaning out any tainted officials. In a legacy from the work choices regime put in place by the coalition more than a decade ago, unregistered organisations are allowed to negotiate for members as red unions without full status at the Fair Work Commission. By keeping the CFMEU a registered organisation with an outside administrator, the government aims to keep the union subject to sanctions against unlawful conduct under workplace relations law. On Monday, Albanese warned that plans by the CFMEU National Office to clean up their own shop might not go far enough, and they're on notice that we'll take whatever action is appropriate. I mean, I have contempt for someone like John Setka. He has no legitimate role in the union movement, he said. The federal move is expected to extend beyond the Victorian branch in order to stamp out problems in New South Wales and Queensland as well. Labor's national response to the scandal has escalated after party leaders in Victoria, South Australia and Tasmania wrote to the National Executive asking for the Construction Division to be disaffiliated from the party. In addition to banning donations from the Construction Division, the party will also stop receiving affiliation fees. Many of the nation's union bosses are refusing to speak out against the CFMEU after ACTU Secretary Sally McManus said on Monday the leaders of the movement stood united against criminality within the movement. A spokesperson for the Transport Workers Union issued a statement supporting the McManus comment but not mentioning the CFMEU, while unions including the SDA, Australian Workers Union, Australian Manufacturing Workers Union and the Rail, Tram and Bus Union declined to weigh in. As the CFMEU National Secretary, Smith has stared down the ACTU's demand to stand aside officials who were the subject of criminal allegations before a crisis meeting of the peak body's executive. Smith also refused to condemn Setka, who resigned on Friday, blaming media scrutiny ahead of the publication of revelations of underworld infiltration in the union and footage of him placing a suitcase out the front of another official's home with the word dog on it. Asked by RN Breakfast host Patricia Carvelis whether he accepted Setka had shamed the union, Smith replied, "No, I don't. I don't accept he has shamed my union." McManus has declined to say what the ACTU will do if the CFMEU does not meet its demands. Master Builders Australia Chief Executive Danita Warren backed the idea of an administrator being appointed. "We want the government to use all their power to remove the toxic culture, including through the use of an external administrator," she said. "Deregistration is not the answer. Tighter governance is." And the corporate regulator has begun a key phase of its investigation into alleged market manipulation by ANZ in formally interviewing staff from the bank's institutional division over unusual trading activity in government bonds and futures. While the Australian Securities and Investments Commission has started engaging with bank employees, the watchdog is yet to grill staff at the centre of the allegations within ANZ's markets unit. However, the regulator is now conducting due diligence and firming up a potential case before conducting formal interviews. The latest development comes after ANZ Chief Executive Shane Elliott and institutional boss Mark Whelan last week said the bank was cooperating with regulators to get to the bottom of the allegations and would take action if required. The matter concerns ANZ's bond trading activity and alleged manipulation of bond futures contracts, as well as broader cultural issues within the bank's markets unit. The Big Four bank on Thursday confirmed it had brought in 2 law firms to uncover any evidence of wrongdoing within the division, as it grapples with the fresh accusations of market manipulation. The prudential regulator also has an open file in relation to the bank's trading in government bonds and futures. And plummeting valuations and higher financing costs have led wholesale office funds to a 19.5% decline in capital growth over the past 12 months, including their worst quarterly performance since the months following the global financial crisis. ISPT's 50 Lonsdale Street Property Trust and Mirvac Wholesale Office Fund were the worst performers. Both suffered a decline in total return of more than 20% over the past 12 months, according to the latest MSCI Mercer Australia Core Wholesale Property Fund Index. The MSCI index covers the major wholesale property funds, which control about 95.6 billion worth of investments in Australia's top office towers, shopping malls and warehouses. They are managed by some of the country's best-known property platforms: Lendlease, GPT Group, Charter Hall, ISPT, Mirvac, QIC, Dexus, AMP Capital and Investor. But there may be more office pain as the write-down of office funds accelerated over the April to June period to negative 8.7%, amounting to losses of double those recorded for the first 3 months of 2024, according to the index. It is not just office that has slipped. The majority of wholesale property funds board posted dropped negative returns, which led to the total return for all funds slipping by 4.7%. In a tough year, retail funds were the best performers, with a total return of negative 7.2% due to higher rents at malls that offset declining values. Another factor supporting retail funds was that structural headwinds, such as the rise of e-commerce, have already passed, while the office sector still faces changes from the shift to remote work. And Qantas boss Vanessa Hudson says there aren't enough passengers in Australia to sustain more than 3 domestic airlines, given how expensive it is to provide services across the country. Speaking in Perth for the launch of the airline's new 17-hour non-stop service to Paris, Hudson said Australia's aviation market differs from the rest of the world because of the country's small population and how reliant the airlines are on domestic travel. Hudson said the demise of budget airline Bonza just 1 year into its operation highlights why the government needs to focus on the sustainability of the market. If you think about why the 3 airlines have really struggled, it's a number of things. Our population, the US, has 250 million, we have 26 million. And spread between the economics of being a viable airline, it's incredibly challenging because it's capital intensive, Hudson said. Comments come as Federal Transport Minister Catherine King gets ready to unveil the government's long-awaited aviation white paper, which will set the policy around the industry to 2050. And that's it for this week. And next week I'll be talking to Sonia Schwabsky, the CEO of the printing franchise Quick Copy, who is spearheading the company's strategic vision and transformation. She'll talk about how she is delivering growth opportunities for franchisees and clients. And I'll talk to Indeed economist Callum Pickering about Australia's latest unemployment figures. For the most exclusive access to leading economists and business leaders from around the world, subscribe to Talking Business from my website, leongetler.com. If you like Talking Business, please leave us a review with Apple Podcasts. Thank you in advance. In the meantime, you catch me on Facebook, Twitter, Instagram, LinkedIn and YouTube. If you want to contact me, email me at leon@leongetler.com. I answer all emails. Also, in my copious spare time, I have a copywriting business. If anyone needs newsletters, blogs, articles or advertorial, email me. Wishing you all a safe and healthy week and looking forward to bringing you Talking Business next week.